Hello and welcome to Crossing the 49th, a cross-border tax and financial planning podcast. I'm your host, Phil Hogan, and today we're going to talk about how U.S. pensions are taxed for Canadians. Okay, so we get this question all the time, whether it's from U.S. individuals moving to Canada or individuals in Canada that are receiving their U.S. pensions. How are these U.S. pensions taxed for Canadian purposes? And we'll talk about how they're taxed for U.S. purposes as well. So I think a good place to start is with the treaty. So what does the treaty say about U.S. pensions being taxed in Canada? So essentially, you're going to pay tax first to the US on any US pensions that you receive. So during this conversation, we'll talk about different types of US pensions, but for now, we're talking about just regular private company pensions, maybe pensions from universities. And then we'll talk about IRAs, 401ks, and then of course, Social Security, which is taxed completely differently. So under Article 18, you're taxed first on your U.S. pensions in the U.S., up to a maximum of 15%. So you'll pay a maximum 15% in the U.S. on your U.S. pension distributions. Then that income is actually going to be fully taxable in Canada at regular rates, and you'll pay Canadian tax on those pension payments. Now, of course, you're taking those pension payments and you're exchanging them to Canadian dollars and taxing them on the Canadian return. So if you just stop there, you would have Canadian tax on your US pension. You would have 15% tax on your US pension in the US, but you'd pay tax twice. So essentially, under the treaty, Canada will give you a credit for up to 15% for any payments that you reported on your Canadian return that were taxed in the US. So that's how the treaty reconciles cross-border pension payments for purposes of tax credits and who gets taxed first. So in summary here, we have U.S. pensions taxed first in the U.S. up to 15%, fully taxed in Canada, and then you get a credit for that 15%, or if you paid less than 15%. That's the amount of the credit that you would receive. Now, this is going to be quite different depending on whether you're a U.S. citizen, a green card holder, or non-resident of the U.S. So let's just first start with you're an American living in Canada or you're moving up to Canada. So you already file a US 1040 return. So you'll be taxable on your US pension just at your regular average rates. If your average rate is over 15%, what you're going to have to do is you resource down the amount of tax you pay on your US return to 15% via Form 1116, which is the foreign tax credit form. So essentially all that's doing is it's allowing you to only pay the 15% maximum rate in the US, and then you fully tax that amount in Canada at your regular rates, and then you get credit for 15. If your average rate in the US is less than 15, then that's what you'll pay on your US pension, and that will be the credit in Canada. So that's how it would work for US citizen living in Canada. If you're not a US citizen, and for some reason, let's say you were down in the US for a little bit, you earned some pension that now you're taking, but you're not actually filing US tax returns because you're not a US resident, you're not a US citizen, you're not a US green card holder, then you'll pay an automatic 15% tax on that distribution to you in Canada. So when the holder of the pension pays you your pension check, they'll withhold 15%. They should be withholding 15%. You'll fully tax that amount on your Canadian return, and you'll get a credit for the 15% that you paid on the withholding. So what happens sometimes is the holder won't withhold 15%. They'll withhold no tax, maybe 15%, maybe 30%. So in cases where they don't withhold any tax, you're actually going to be forced to file a non-resident US tax return to pay that 15%, which is not really extra taxes. You're going to get a credit for that in Canada. If you overpaid, so let's say somebody sent you a pension check and you paid, and they withheld 30%, then you could also file a non-resident US return and recover the difference. So you would pay the 15%, the 30% that was withheld will be a credit, and then you'll get a refund of 15%. You don't want to go through that hassle. If you know you're going to be receiving pension income from the US, make sure you ask the holder how much are they going to withhold. Like if you're a US citizen living in Canada, it's not such a big deal because you'll be able to get credit for that on your regular 1040. But if you're not filing US tax returns every year, it can be a pain to actually file that non-resident return. So, a couple minutes on the phone trying to just confirm that they will withhold that 15% is good practice. Okay, so we talked about being fully taxable in Canada. We talked about foreign tax credits. I'm just going to circle back around to that resourcing that I spoke about earlier. So this is a concept that is actually quite tough to really kind of grasp. But the idea here is, if your average rate in the US, so for our high income earners, if your average rate on your US pensions is over 15%, the maximum that you should be paying is 15%. But let's say your average rate in the US is 20%. Then if you didn't use that foreign tax credit mechanism, you would actually pay 20% to the US. You would try to get a credit for the 20% in Canada, but if CRA looked at it, and CRA looks at foreign tax credit reviews all the time, they'll actually disallow that extra 5%. So you have to make sure that you only pay 15%. And the way you do that is with that 1116 form on your US 1040, which is the foreign tax credit form. So very important to resource that amount down to 15%, because that's the maximum you should be paying on that income. So let's talk a little bit about, so we talked those, those would be for, regular pension payments, once again, private pension payments, university pension payments, any pension payment that you would receive from an entity. We also have, lots of clients, of course, have IRAs and 401ks, and the rules are pretty similar. 15% withheld if you're not a US person, average rates if you're a US person, then you're just filing US returns. So pretty similar for IRAs and 401ks. The big difference between, let's say, a regular university pension and an IRA, specifically under the Canadian tax rules, you can income split pensions if you meet certain criteria over a certain age, but IRAs are specifically excluded. So if you take a distribution from your IRA, you can't split it for Canadian purposes. You might be filing jointly in the US, but really it's a Canadian tax you're probably more concerned about, because in most cases you can pay more than 15%. So you can't split IRAs. So just remember, when you do split other pension income, so let's say you have a large university pension, and you're splitting some of that with your spouse that might have a lower income, make sure that the tax you pay on that in the US is also going to be allocated on the Canadian return the same way. And all that means is if let's say you're paying 15% tax on that pension payment, you don't take the full amount of the 15% as a tax credit if you're already splitting that amount with your spouse. So that can be tricky, because a lot of the software now doesn't do this automatically. So you have to know that if you're gonna, let's say you have a $100,000 pension, you're splitting half of that with your spouse. The 15% that you paid, the $15,000 you paid as withholdings, has to get split between you and your spouse when you do the foreign tax credit calculation on the US side. And I know we're going back and forth with foreign tax credits here, 15% in the US and average rate in Canada, but really the most important thing to really understand is you're going to only just pay the highest rate country. So if your average rate in Canada is 20%, that's what you're going to pay overall. It doesn't feel like that sometimes, because you pay 15% to the US, you pay 20% to Canada, but the 20% in Canada, you're going to get a credit for 15. So your net in Canada is going to be 5%, but you've already paid 15% in the US. So 15 plus 5 is the 20%, which equals your Canadian rate. So you're almost always going to pay your highest rate country rate. And of course, in Canada, it's often the Canadian rate in most cases that you'll pay. Okay, so let's talk about Social Security payments. Those are completely different than regular pensions, IRAs, 401ks. So the U.S. Social Security payments, and this is often a surprise to individuals, I'm not surprised that it would be surprising, because U.S. Social Security payments are only taxable in the country where you're a resident. So, most of my clients are Americans living in Canada. For those clients that earn U.S. Social Security payments in Canada, they're only taxable on the Social Security payments in Canada. The Social Security payments don't get reported on the U.S. return. However, in order to exclude them, you have to make sure that you file that treaty election form that I've talked about all the time, 8833, to exempt the Social Security payments. And then on the Canadian side, you'll get a 15% deduction unless you actually have been receiving Social Security payments before, is it 96? Which, we do have some clients, but in most cases, it's going to be after 96 that you receive these Social Security payments. So yeah, just important to understand that you're not going to be reporting your U.S. Social Security, and certainly not paying tax on your U.S. Social Security in the U.S., only in Canada. But in order to make that happen, you have to make sure that you file that treaty election form. And I see this a lot with, either files that we're taking over or older tax returns from other individuals, where they might tax the Social Security on the U.S. return, tax it on the Canadian return, and then take a foreign tax credit for that amount on the Canadian return. Now, the effect is likely the same. The overall tax is likely the same. The problem with that is if CRA reviews your tax return, they will kick out your foreign tax credit, and then you would be forced to go back and adjust your US tax return. And considering how behind the department is, and many of you have read the stories about them shredding, paper filed returns and information returns because they're behind by 2-3 years. You definitely don't want to have to file adjustments if you don't have to. So yeah, if you make sure you do it properly first, and then if CRA looks at it, then they'll just be fine with your calculations and you move on. Because once you start doing adjustments back and forth, it can be tricky if you're waiting. I mean, if you're waiting 6-8 months for these adjustments to go through, that's a lot of time and effort for a small amount of time to do it properly. Okay, so we talked about foreign tax credits. We talked about regular IRAs, 401ks, things like university pensions. We talked about Social Security and how they're taxed. So that I think we'll stop there. I mean, there's certainly a lot more to get into in terms of the nuances of how pensions are taxed for Canadian purposes, especially when you get into splits. But really, the takeaway here is certainly you need to only pay 15% on your US pensions in the US. If you're paying more than 15%, there's likely an issue with the tax returns. Now, of course, there's a whole nother conversation about lump sum payments versus periodic payments. Administratively, the IRS and CRA seem to be sticking with 15. So if anybody has issues with that, please send me an email and we can chat. So make sure 15% maximum tax to the US. If for some reason you're not filing US returns and somebody under withheld or over withheld on the pension payment, make sure to file that 1040NR, the non-resident tax return, to either pay the extra amount that you need to or get a refund of the 15%. And of course, with income splitting, if you do split any of these US pensions, make sure that your spouse gets credit for that US tax that either you paid or you paid jointly on the 1040 return when you filed married filing jointly. So, well, hopefully that was helpful. Anybody that's receiving US pensions or will be receiving US pensions in the next few years. If you have any questions on this, don't hesitate to send me an email to phil@philhogan.com. If you like this video and you want to see more of these, it would be a great help to like, comment, share would be absolutely amazing. Make sure to subscribe to the channel. And if you click that alert button, as soon as new videos are posted, you'll be alerted. So once again, big thanks to everybody that supported the channel. Hopefully we'll be doing many more of these now that we're past tax season. So yeah, once again, don't hesitate to reach out. And if you have any questions on this, a great place to ask those questions is actually in the comments of the YouTube video. So once again, thanks to everybody, and we'll see you soon.